All right, testing 1, 2, 3. Sorry, got a little bit of a late start. I had to restart my computer and make it happy that it was updated. Anybody out there? Anybody can hear me? La di da, di da di da, di da di da. I cannot believe it is June 1st already. That is crazy. Oh, man, it was flying past. Let's see. All right, good. So let's try the screen thing, see if you guys can see my screen, and then we'll be ready to rock and to roll. La di da di da di da. La da 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 da. Okay. See how things are looking. Not so bad. All right, let's get this show on the road then. Fantastic. All right. Shoot, wait a minute. Oh, there's a button. Go.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, nor its affiliates, nor any of their respective officers, personnel, or representatives, agents or independent contractors are in such capacity as licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OC website. Trade characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, fantastic. So how are we looking? Struggling back, trying to get back to 4,100 on the S&P. And we got the beige book coming up shortly at 2 o'clock. Now, we don't take this drop too seriously because it's a, excuse me, it is a dollar-based drop. So that's what we were talking about this morning. You know, this falling of 1% coincided with this rising of 1%, so it's meaningless. It's a nothing move. In other words, what happened is the stocks repriced to the currency. We talked about that before, not going to get into it all again. Bottom line is, though, that when you see a dollar move and the markets move with the dollar, you ignore it and then wait for things to settle down. This doesn't mean anything. So we played for the bounce on the S&P earlier. You can't even see it anymore. When we first hit 4,100, we played for the bounce to 4,112. That happened exactly as predicted by the 5% rule. Also, as predicted by the 5% rule, when you get back to the weekly bounce and you fail it, you are probably going to fall back to a lower level. And that's exactly what happened. And, you know, and look, it's no small thing because we make home. Let's see. We made $600 on that bounce, and we knew it was going to happen exactly the way it happened. You know, trading is mostly about waiting for this to happen. So, I'll show you how this works. Maybe if I can find it. we're just watching, seeing what happens. And I said it's at 1042. It's a dollar-driven drop. I like ES 4100 for the bounce, tight stops below. It's 1042. Then I came back at 1044 and said, what bounce? So what's a bounce? Well, we fall from 4160, and you can see this on the chart. And don't forget, this is 1044, so we're talking about this before 11 o'clock. And I said, so what's the bounce that we expect? So as we're touching 4100, I'm saying, well, we fell from 4160, right? It's not complicated. We fell from 4160. We ignore these spiky things. To 4100, so that's 60 points. 60 points times 20% is a 12-point bounce, and a bounce to 4112 weak and 4420. I meant 4124 strong. I said you can see how 4112 became resistance on the way down. Let's get to the other chart. So a weak bounce is all I expect, but that's good for 600 bucks. All right. So in other words, what I was saying is on the way down, you can see how we came down to 4110, touched 4112, but that was resistance. We couldn't get back over that. So it already showed itself to be, where's the actual 4112 line? Here, around there. Okay. So the actual 4112 line is there. So in other words, what happens is we tried to get back over it. It already proved itself. So long in advance of anything happening, you can see how the weak bounce line comes into play. The strong bounce line, which is 24, which is here, did not really come into play at all. So the bounce line that did show up was the 4112 line. We had a little bit of consolidation there, and that meant that when we were down here at 1244, where's the time? Here, see 1040? Not whatever time it was. 1044, right? Yeah, 1044. So when we're talking about it here at 1044, when it's all the way down here, I'm saying 4112 is going to be the bounce line, okay? How much you make though? You make $50 per point. That's 600 bucks per contract. It's not nothing. We don't often know what's going to happen, but sometimes we know exactly what's going to happen because we can see that our rules are being obeyed. So when we can see that the rules are being obeyed and we know where the resistance lines are and we know where the support lines are, that's when you make a play. When you have a very strong probability of making the correct play. Don't play when you don't know. But so it was a dollar-driven rally, and that meant the support on the S&P was likely to still trigger. In other words, nothing had changed. And again, this goes from reading the news. Earlier in the discussion, we had read the news and said, well, I don't really see anything particularly moving the market down. So therefore, this entire move down is being driven by the dollar punching up. And if that's the case, then the support triggers, which would be based on, they're not going to change based on the dollar. Generally, you're not changing your support levels based on the dollar because it's a short-term temporary fluctuation, so it's not worth somebody trading in and out of something based on what the dollar is doing, not an investment house. So those machines that have their buy programs are going to trigger like they normally do at the normal levels that you expect them to trigger. So at the 4100 line, buy programs trigger. They take you back to the weak bounce line. But if there's not enough support, which we didn't see where there would be support coming from, then the weak bounce fails and you head further down. How low? We don't know. That we don't know. Okay. What you do know, though, is if you have 12-point bounce lines, right, then you've got 12-point retracement lines. So that means 88 would be one level, and you can see 88 zone over here. And below 88 is 76, right? So 76 is where you expect to see your next support, and there it is right there. So that's a strong retrace is 88, and then 12 below 88 is 76, and that's where you're going to bottom out for the next series. But again, that's assuming all things are being equal and assuming that the dollar is really the only factor. And also the dollar, what's going to happen to the dollar? Well, the dollar is going to move probably not more than 1.25%. And we didn't even get a 1.25% move in the dollar, I don't think. If we take the low of the dollar as yeah, let's ignore these spikes and say it was 101.90. So 101.90 to isn't, it's not even moving 1% higher. That'd be 102.90, right? At least. So we're not even getting to 102.90. So you're not even getting a 1% move in the dollar coming up. And we'd be looking for 1.25% move in the dollar. So there's nothing very impressive going on here. More to the point, what you've got is a bounce off 102, ignore all these spikes, and then what's half of 102.5 is I mean, calculator. So, you know, when you have a 5% move, you divide that by 2 is 2.5 divided by 2. Oh, that didn't work. So 5 divided by 2 divided by 2 is 125 divided by 2, 625. So if we're at 102 times 102 times 1.0625 is 102.6375. So 102.63 right there. Okay, that's your first move in the dollar. And remember, the more something is traded, the more of those incremental pieces of the 5% rule are going to kick in. So in other words, on the S&P, which is a broadly traded index, we very often see 0.65, 625, and 1.25% moves. In the dollar also, that obviously, I mean, probably nothing in the world is more heavily traded than the dollar. I mean, you're trading dollars every time you spend something. Every time you pull out your wallet, you're trading dollars. You're trading dollars for merchandise, right? You're trading dollars for labor. You're trading dollars for materials. And so is everyone else in the world everywhere. So the dollar is constantly being traded. 24 hours a day, 7 days a week. That's why you very rarely are going to get major moves in the dollar. It's just traded too much to be heavily affected by any single thing. Indexes on the other hand, is shut half the day, so they'll trade differently. You know, they shut part of the day or are very thinly traded at night. They are subject to much bigger moves because they snap like a rubber band. Nobody's been trading them, but they still react to market conditions. But the dollar is constantly being traded. There's no real time off for the dollar. Anyway, so those incremental moves matter. And the bigger something is, the bigger those moves matter. But if you're in thinly traded things, you know, relatively thinly, especially like stocks or things like that, especially if you get out of the large cap stocks, then honestly, any move below 1.25% becomes pretty meaningless. That's why it's called the 5% rule. The 5% rule kicks in on almost everything, but below that, you've got 2.5%, 1.25%. Those are your different increments of the 5% rule. And they all matter and they all have their own internal bounces and so on and so forth. So when you're looking at the daily moves of the dollar and an index, et cetera, then all those little things start to matter a lot. All right. So meanwhile, what's going on? So we're creeping back. So there's been some bad economic data. The Hyundai car thing, that was interesting this morning. I don't know if any more news came up. Well, my day has gone crazy. I don't know what I was doing all day. I really have no idea what I was doing today. No, I know what it was. I was trying to. I was checking the long. I know what I was doing. I got heavily involved in looking over. I didn't print it, but I've been going over the short-term portfolio and going over the long-term portfolio and trying to make sure that we are adequately balanced is the trick. And I decided we are. But I looked at a lot of the positions, so it takes very time consuming at this point, especially with all these freaking positions that we have. The short-term portfolio, notice we have more cash in the short-term portfolio than we do positions. Our positions are actually at a loss at the moment. So we take cash out of our portfolio in order to liquidate. But still, that's very nice. I mean, this portfolio started off with $200,000 in 2020, in late 2020, and we're at some huge number now, whatever it is. We're at 1.2 million now, so we're up $1 million. I mean, that's pretty freaking huge. That's a short-term portfolio. So in short, hedging has been a good idea, right? Obviously, since we picked up $1 million on our hedges. And in the long-term portfolio, but it's not just hedging, because we make bets, like we played Tesla short, which obviously made a lot of money. We played Wayfair short, which made a lot of money, but then cost us a lot of money too on the leftover piece. In the long-term portfolio, that's more impressive. We're up 300%. It's not the same as being up 500% in the short-term portfolio, but the size of it is different. In the long-term portfolio, we started with $500,000 in 2019, and now we're up to $2 million. And here the securities actually do have some value. We have a ton of cash. We have $1.5 million worth of cash. So we're in no shortage at all of this. We have a huge amount of short puts, though, 37 short puts. Some of them are in a bit of trouble, but not, look, again, trouble is a relative term. And so in other words, like, look, we're down 100% on our CIM puts, but the CIM puts $15 and we sold them for $3, so that's 12. So we're forced to buy CIM for 12. I don't care. I don't care if I own CIM for 12, especially 2,000 shares for $24,000. That's not really something I'm going to worry about in this portfolio. So they'll either come in or we'll own more CIM. We just double down on CIM anyway. It's a REIT that pays a huge dividend, in case you don't know. Crocs, 65 puts, sold for 12 bucks, nets us in for $53. It's at $56. So I really don't care if it says down 73%. I'm still over the net. It's only down because of the huge premiums that are put on it at the moment. So I'm not going to worry about that. And do I mind owning Crocs for 53? No, I don't. That's the point, though. If you sell puts on positions that you really would like to own for the net price, none of this stuff is going to bother you. Coin we just rolled, and that's actually improved a bit. 5 again, we sold the 120 puts for 15 bucks, so let's call that 105. 5 is at 127. Our net is our net is 105. It's a 120 put, and they're telling us that we're down 76%. That's Five Below. That's like a dollar store. It's a $5 store. It's not a dollar store. It's a $5 store. So it's everything in theory. I don't know how they still do it because of inflation, but in theory, everything is $5 or below at that store. It's like Woolworths when we were kids. I love that. That was my favorite thing. Going into Woolworths and buying junk for 10 cents and 5 cents. I do with my kids too. My kids love going to the dollar store. I give them 10 bucks each and be like, hey, have a party. They come back with a bag full of crap. They love that. So anyway, so how stupid, but you have to learn to ignore things like that in your portfolio. It's like, this is a meaningless number. I don't care what it says. I am in for net. I'm in for 120. But I got paid $15.50, so I'm in for net not even 105, it's 104.50. So I'm in for net 104.50. The stock's at 127. What am I going to do? Abandon that position? Makes no sense. It's a perfectly good position that's working. It only says it's not working because people are paying ridiculous prices for the short puts. Las Vegas, the 40 puts we sold for 6 is 34. Las Vegas is at 34, but it's telling me I'm down 72%. Not down anything. It's at our net price. MGM 40, we sold for 6, also 34. It's at 34. It's our net price. We're not down. It says we're down 75%. I don't care. If you just wait, you'll make 4,500 bucks on these positions. Netflix, we sold the 350 puts for 50 bucks. Now that's 200 bucks. That's not 200. That's 300 bucks. These we're actually down on. But long term, I think Netflix will come back, and if it doesn't come back, we're going to roll the puts. It's only 5, and we're not too worried about it. Down 50,000 bucks though, very painful. But I don't mind owning and starting a Netflix position at this level. What level? 300 net dollars, or 295 or whatever it is. But the thing is, it's not 295, because if we're forced to buy 500 shares of Netflix at $300, that's 150,000, right? But there are 2 things that we could then do. I can either, well, first of all, we can roll. That's one thing. So we're not actually going to have to do this anyway. But assuming we don't roll, okay, we have the Netflix. Whoa, what the hell was that? We have the Netflix 300, right? There they are. They're at 118 bucks right now. Now, there's several things we can do. First of all, when 2025 comes out, we're going to get a free roll to roll them lower. If these were the January, puts that were, oh, for God's sakes, it's because it's not coming to the edge over here. That's why. So maybe if I make that bigger, there you go. That should help. So what? I'm sorry, 300. They're 120. So the 2023 puts at a 120 are the 310s. So we'd essentially get a free roll, not a big one though. We'd get a free roll of a year, and we can roll down $10 basically. It's not a very good roll at all. So we get a $10 credit for rolling down next year. So we can assume we can get into the 2025s at probably the 290s or something like that. That's not exciting. So we're going to certainly want to double it down. So either we take the assignment, and let's say they're at 190. Okay, if they're at 190 and I take an assignment at net 250, right? So that was our original. So if we get assigned at 250 and I buy another round at 190, divide that by 2, then I'm in for 1,000 shares at 220, $220,000. Okay, but then what can I do? Well, even with the stock at 190, and by the way, if it stocks at 190 and you're at net 220, you're not in such bad shape, right? But then I can sell the 2024, even if this happened tomorrow, I could sell the 2024 200 calls for $50. So then it's minus 50 is 170 would be my net. But then if I sell some 160 puts, well, let's say the 165s for at least 30 bucks. So minus 30 is 140. So then I would be in the 140. I'd be in the stock for 140, $280,000 worth of Netflix. No, I'm sorry, not what am I talking about? I would be in the stock for $140,000 worth of Netflix. We'd be in 10 shares, 10 contracts, 1,000 shares for $140,000. Okay, keep in mind my obligation currently is for $250,000. I'm sorry, it's for 125. My obligation now is for 500 shares at $300 less 50 that we got for the contracts. So my obligation is 500 times 250 is 125,000. If I double down, if I get assigned and I double down at the current price and I sell puts and sell calls, then I'm in for $140,000, just $15,000 more than my initial commitment, but I actually own 1,000 shares of the stock, double what we started with, and I'll get called away at $200 with a $60,000 profit, which is very reasonable, and that's $200 is basically the current price. So we're in the money. We've got a $60,000 spread. And if I get assigned more, it would be at $165. So plus 165 divided by 2. So my average would be $152,000. And then I'd be in $300,000 worth of Netflix. I'd have 2,000 shares of Netflix for $152. Then I'd be up to $300,000. But what would I do then? I'd sell more puts and calls. And those puts and calls are going to drive my net down below $100, right? So if I sell puts and calls and drive my net below $100, that's my risk. My risk is only 2,000 shares of Netflix for about $100, for $200,000. I have zero fear of this situation happening. Not in my $2 million portfolio. It's not a bother to me. I don't mind if Netflix at $100 becomes a big part of my portfolio. It's at 200 now. Okay, and meanwhile, if that changes, where am I? And meanwhile, if that changes, I take my $50,000 loss and go away. If for some reason I lose my faith, maybe it'll be $70,000 loss. But in other words, my choices here are my net assignment would be I sold the 350s for it was the 350s for 55. So it's a bit more than I said. But I sold the 350s for 55, so I'm in for 295, not 250. I was made a mistake before. I thought it was the 300 puts. So I sold the 350s for $50. And my net's 295. So anyway, so my commitment, same concept though. My commitment is for half of 350. I'm sorry, half of 300. So my commitment's for $150,000. But after rolling in, et cetera, I'll really end up owning 1,000 shares for roughly $200 or less than $200, so $200,000. It's not that big of a deal. And if I have to double down again, I'll drop my net almost to $100, and it's still going to be $200,000 for 2,000 shares. I don't have a problem with that. In fact, I mean, frankly, this is the point. If you're going to sell the puts, you have to assume that's going to happen to you. And you notice we don't sell a lot of puts that are that expensive. I don't like to, but I felt comfortable with Netflix because it's a subscription service, and it was unlikely to get destroyed like that. It did. It was very weird that it got killed, but I did not think it was likely that the subscription service would have their ass kicked like that. Because if you look at them, what's this? Stockopedia, right? Oh, how's Generac doing? A little better. NFLX. I mean, it's not like some .com thing. It's they got look at the sales 29, 32, 35, right? 20, and it's historical 8, 11, 15, 20, 24, 29, 32, 35. They gain 10% a year very, very steadily. Now remember, last quarter they had a drop in subscriptions. So people are freaking out, but it's really nothing to freak out about. They're making $5 billion a year, and you only have to pay $87 billion for the whole company, which is like 17 times earnings. So they're perfectly reasonably priced. I certainly can't see how everybody's going to cancel Netflix. And by the way, I talked to my kids about this and their friends. Nobody's canceling Netflix. Netflix is the go-to for the younger generation. They would cut off they would rather lose their iPhone than lose Netflix, basically. Which although they wouldn't have anything to watch Netflix on because they watch it on their iPhones. But Netflix is what they watch, and that the thing that Netflix is forcing people to pay for subscriptions is not going very well. They thought they were going to save themselves by cracking down on subscription sharing, but that's not working out for them either. So they got some bumps in the road ahead, but over the long term, I think they're going to be fine. And And I don't see any major subscriber bleed. And again, you're talking about, oh no, that's depressing. How many Netflix subscribers? Look at this. 79 million, 99 million, 124 million, 151 million, 214 million. Look at this. 79, 99, 124, 151. I imagine there must have been a 170, 180 in there somewhere. And now we're up to 214 million subscribers. 54% watch Netflix without any subscription fees. That's crazy. That's got to be annoying the crap out of them. So if they have 214 subscribers and half the people watch Netflix without spending, they have 400 million viewers, which is why they're doing this advertising thing. 400 million viewers is more viewers. That's more than HBO. That's probably more than most TV networks. There's billions of dollars in ad revenue they could generate from an advertising model, and that's what they're looking for. They're trying to say, we're going to crack down on subscribers, and we're going to force these 54% of the users who watch this for free to start watching some advertisements if they don't pay for us. And by the way, I know how to do that. The way you do that is what you do is you set a thing on the accounts and you say to people, you're like, your primary user and one beneficiary can watch ad-free TV, and other people have to watch and pay and watch with advertising. That's all. They'll watch with ads. If you're a subscriber, you would get only a few ads. If you're not a subscriber at all, you get a lot of ads, like a regular TV show. Very simple. Just hear it out. That's all they got to do. It's not hard. I mean, people make things so complicated when they don't have to. And Statistic is saying 221 million subscribers. I love Statistica. Look at this. So a little plateauing because of the pandemic, but that's because they had a huge growth of subscribers into the pandemic. But I don't give a crap as long as they keep generating this as long as they plateau at 5 billion, they're underpriced. And they'll figure out more ways to generate revenue. In other words, their model is based on getting subscription revenue. They got a lot of new subscribers that aren't paying revenue, so they have to rethink their model. But once they figure out and rethink their model, they'll make tremendous amounts of advertising revenue. It is really not that hard to conceive, but they've got to figure it out, and the investors have to figure it out, and the analysts have to figure it out and understand the model and how it's going to change over time. But again, I'm not in love with Netflix. I just think it's a little bit cheap here. Therefore, I'm willing to put my money on the line and say, okay, we'll take it now. At this point, we're willing to buy it. That was Netflix. Target. Seriously? Target. I can't believe this one. All right, so Target, we sold the 200 puts for 20 bucks, so we're in for 180. It's at 160, so we're negative 20. It's showing negative 51. So it's showing 30 more times 5, 15,000. It's showing $15,000 more loss than we really have if it finishes at that price. And that would be obviously the entire loss. Essentially, is overdone. Don't even get me started on Target. This is really an overreaction. But of course, that's what we use those short puts for. Is we decide like, oh, it's time to buy something. It's time to jump in. Target. So in other words, rather than saying this is where we have to freak out, we say, oh my God, this is where we have opportunities to jump in. I do not want to jump in necessarily and own Netflix. I don't want to make a huge bet on Netflix. We're already committed enough. Target, different though. Target, I may want to jump in and buy it because it's just too cheap. We're down to $75 billion on Target. And again, like Netflix, $5 billion a year. Steady, wonderful growth. Profit, steady, nice growth also. There's a bump in 2022 for whatever reason. And it's not important. But they're trading at 14 times earnings, which is stupid. Walmart, which is getting better press at the moment, is trading at 20 times earnings. So why would I not want to buy Target at 14 times earnings and buy Walmart at that? Costco is trading at 30 times earnings. Target is the bargain of the group. So these short puts alert us to stocks that we may want to start putting some more money into. If it wasn't such a bad market, a scary market, we would be putting more money into a lot of these things, but we're holding off and waiting and seeing what happens. Toyota, not an issue. Here's one, W Wayfair. Now, we don't like Wayfair, and they just keep going down and down and down. We're getting killed on the short puts. We made way more money than this on the short. Our position was short. These are the puts that were left over from the short that we dismantled. We don't really care that much. I'm really waiting for 2025 to come out so that we can roll this to the lower 2025. But I'm not a fan of these people at all. So that's a tricky one. I mean, you know, we may just take the loss and give up on them at some point. Now, otherwise, what's more important here is to look at what did we do with the long-term portfolio. I want to show you how this works out. Because look, there's no point to following the strategy if you don't follow through with the strategy. And that means, here you go, May 20th. So in other words, on May 20th, we did our long-term portfolio review. All right. And now, of course, if you have a $200,000 portfolio, not a $2 million portfolio, then just trade a tenth of whatever we're trading, obviously. Not only that, though, but the other very important thing is, of course, stay away from the $300 stocks. Don't trade them. Don't trade $200 stocks. Try to trade stocks that you can afford. If you can't really afford to buy something, by no means should you be selling a short put against it. You know, we don't do those kind of trades until we're way ahead. We're so many miles ahead in the portfolio. We're up $1.5 million. So yeah, we can afford to make some trades that commit us to some large numbers. All right, but what do we do in the long-term portfolio? So keep in mind, this is May 20th when we adjusted. So on Coinbase, we made an adjustment. I'm not going to go up and down for all of them. It's going to be annoying. I said we're obligated to own 500 shares of Coinbase. I think Coinbase is a good long-term play. So instead, we're going to sell 15. So we're taking 5 short $200 puts, and we're moving into 15 short $100 puts at 75,000. So we were committed to own $100,000 worth of Coinbase. Forget what we sold it for. Now we're committed to own $150,000 worth of Coinbase. So we've increased our commitment by 50%, but the strike is significantly lower. Now, Coinbase is only trading at, well, it was lower at the time, like $60 or whatever it was. But I strongly believe that it's super oversold here. You know, Coinbase isn't Bitcoin. Bitcoin crashed, all the cryptos crashed, but Coinbase isn't the crypto market. You know, this is like selling off the ICE, the commodities exchange, because gold and silver crashed. You know, yeah, sure, you could argue there'll be less trading. Activity may dip. People might not trade as much. They won't get as much commissions and fees, but they're not directly tied to the price. And Coinbase is not directly tied to the price of cryptocurrency, only in that if the market dies out, that would be bad for them. But what's unfortunate for Coinbase, though, is they started investing in building an NFT side of their trade, which is very expensive to set everything up. You know, regulations and all that they have to meet. And the NFT market completely crashed out on them while that was happening. That, you know, and of course I've been telling everyone that's bullshit anyway, that market. Well, the whole thing's bullshit, but the coins will trade. The concept of the coins, the concept of blockchain trading is good. It just shouldn't be treated like it's currency. But blockchain is great. You know, we're working on a blockchain for carbon credits that's going to be hopefully adopted as a major form of exchanging carbon credits around the world. That makes sense. You're trading something that uniquely identifies another thing. But in and of itself, the blockchain items, which are effectively coins, but you don't want to call them coins, everybody will freak out. But the blockchain coins that we issue that people can take and hold represents an actual amount of carbon credits that are real, that there are certificates. Each one is tied directly to an actual certificate of a carbon credit. So you're actually trading carbon credits. We're allowing for the free exchange of carbon credits from one person to another, to another, to another. So when you're driving your Tesla and you generate a carbon credit, we can actually give you a coin. Your coin represents the carbon credits that you have legally generated that are legally tradable to another entity, but rather than go through the paperwork nonsense that has to be gone through, you have a unique identifier that allows you to trade it back and forth. Okay, so that's what we're working on now. Anyway, so Coinbase, that's what, for me, the value of Coinbase is there's a real underlying value to blockchain technology that Coinbase doesn't even have to know how it's going to eventually work. It's just that if it eventually works, they've got a very good platform for trading it back and forth. But boy, is it a painful thing down here right now. Anyway, here's Chimera. And I said, at the moment, the $8 calls. Now, see, you can't do every one. We can't take every single thing and add to them. But Chimera, we had the puts. And I said the $8 calls and puts are 175 each. Oh, I'm sorry, that was a full position we have on CIM. See, we had 3,000 and with 30 short calls and 20 short puts. And I said basically that we may as well just double down. So we're buying 3,000 more. We're buying 3,000 more for 17,250. And we're getting the dividends and so on and so forth. So it doesn't make sense. It was just, it's just silly not to at that price. So we doubled down on Chimera. When it was, and again, this is May 20th. When it was down here, we do it. Did we know for a fact that's the bottom? No, we don't know for a fact that's the bottom. We're going to do it again if it goes lower. It hit a point. There's a stepping pattern to the sell-off. So in other words, we're doing what we call scaling into positions. And the key to having again, 1.5 million, three quarters of our portfolio is cash. So we've got tons of cash to adjust our positions. Do we adjust every position? No, but there are certain positions that we feel are really, really down as far as we want. So on our value proposition, we look at those and we decide how far they're down. But again, we're deciding how far they're down, generally at least 20%, usually 40% we want to see. So they have to be pretty deeply there because 20% you can bounce right back. So I'm not going to chase at 20%. When the whole market is down, if the rest of the market was great and my stock went down 20%, then I might move on my stock because it's the only thing down that I could really, add to and get a good value if I feel the value's there. But when the whole market's down, I'm not impressed that my stock is down 20%. I want to see some real damage before I'm going to make a move. Everybody's down 20%. So I'm not going to sit there and adjust every single stock. I want to take the ones that I feel very strongly about, that I feel that are not likely to drop another 40%, but even if they do, I'm happy to add to it again. So brings us to Boeing. With 7 years worth of back orders on their planes, finally shaking off all the little issues they had with their planes. So did I know that 120 was a dead bottom on Boeing? No, I did not know it was a dead bottom on Boeing, but it's a time. Coming down from 180 to 120 is that 40% drop we're looking for. We're probably going to get a bounce, and it's a good time to make the roll. But it's only an interim step. If it goes down to if it goes down from here to 80, I'll roll it again. Because it's getting silly. And we go back to basic valuation, Boeing, So we're down to $77 billion. They make, see, this is tricky because look at these horrific losses, right? But they make in a good year $10 billion, and you can buy them for $77 billion. This is where it's a little bit of a leap of faith. I believe they will have good years again. They do have 7 years of back orders. That's the key. You can't say that about Target or Netflix or anybody else. They've got 7 years of customers waiting to buy everything they can possibly make. So they've got this, they've got these guys. They're here. What they got to do is stop losing money. What do they have? They have supply chain issues, they have labor issues, they have inflation issues, they have plenty of problems. Here they had grounded planes and so on and so forth. The grounded planes are going away. That's fixed. Now they got to deal with the supply chain, the labor, and the inflation. It's a lot of shit, but 7 years of back orders gives them time to fix it. The debt, $45 billion. And again, our rule of thumb with debt, and that's net debt, don't forget, so that includes their cash. So our net debt is $45 billion times 0.02%. So that's 900 million. So basically it's $1 billion a year of debt. So I don't think they're going to earn $10 billion. I think they're going to earn $9 billion. I got to knock $1 billion off, because with everybody's debt, we should assume that debt's going to be 2% higher to service. That's a fair approximation. The Fed, for a fact, is raising rates from what is currently, don't forget, this debt is not based on what happened to them in May. This debt is based on what they paid last year. So their debt currently and their interest on debt is what it is, whatever it is, but 2% more is another $900 million a year. It's another $1 billion basically a year. How are you going to escape that? When the Fed is raising rates, they just raised rates a 0.5 point. They're going to raise rates another point in the next 2 meetings. Overall, they're going to raise rates another couple of percent after that. There's no way that a company with debt isn't going to be paying 2% more interest. Now, if they're smart, and Boeing is smart, and they see this coming, and Boeing saw it coming, they're not idiots, they would have arranged their debt in such a manner that most of their debt is covered for quite a long time under the old rates. But just to be safe, we assume for every company, 2% more debt is going to take a bite out of their earnings. So we assume that every number we see going forward is going to be knocked down by not by 2%, by 2% of the debt. So $1 billion taken out of earnings. So even if I think they're recovering to $8 billion, $10 billion, I have to assume that's $7 billion to $9 billion and no longer 10. But $9 billion of earnings at $77 billion for the whole company, I'm still taking it. Hence, happy to press my bets on Boeing at this point. That's a decision tree that goes on. So Baba, I think we're brave enough here, right? I said that. Big lots, I'm happy enough with our targets on big lots. And look what happened to big lot. They went lower. So now I'm more likely now than I was on the 20th at 30. Now that they've dropped 20% below that, now I'm more likely to press my bet on big lots. Beyond text, Boyd, and we took advantage of Boyd, and look at what happened to Boyd after we pressed our bet, right? They had a nice pop. Cheesecake Factory, we just talked about that yesterday. I can't believe that this is I can't believe that you can pay $30 there was $30.50 at the time, and I was like, I can't believe that $30.50 is the price. So I said, out of principle, we have to roll this one down. So we rolled down to the 35 calls to the 25 calls. We went from the 35 calls we had to the 25. So our target, our bottom line on the target was there. And if it goes lower, we're just going to roll down on the 15 calls. And I'm perfectly happy to wait a couple of years for the Cheesecake Factory to turn around holding 15 calls. Now you say, okay, but you only have the 202 for 15 calls. Obviously, we're going to roll for time as well when the new calls come out. Can't do anything about it when they're not out. But when you roll for time as well. You can always roll for time. That's always going to be about the same price. It's usually about $1 or so a year. You can always roll for time. That's not the issue. Rolling for position is what you got to take advantage of when it's down. So here's Delta. Delta's holding up, doesn't need help. Here's Dell. That's a double down. I said you've got to love algo selling. 4110 is 31 billion dollars, and they make 5 billion a year. I don't think this. I didn't get into it here. Of course, it's just a review. The thing about Dell, and this goes back to the early days of computing. Okay, Dell's computers that are made up of other people's stuff. They're not like Compaq or HP where they make all their own stuff, right? So like an HP computer is always a certain thing. Dell's not like that. Dell is like if you made a computer yourself by ordering components online. So what they do is they're constantly reconfiguring and reassembling their computers using the best available parts that they can get good deals on. So they're always going to aim to be in a certain range. So if you get an XPS, it's going to have this and that and whatever, it's going to be this. They try to stay like at the performance levels of the model, but they're not wedded to any certain chips. They will buy a batch of chips at a good price, a batch of video cards at a good price, a batch of processors at a good price, and they will put that with this and this and that, and they configure it and optimize it themselves as if they were the hobbyists. Right? Like my oldest daughter, Madeline, she will only make her own computer. She and her friends are all geeky people who love to make their own computers. They don't buy anything from the store. They think it's all crap. They think they can do way better and put a computer together way cheaper from online parts. I was kind of skeptical about this when they were all in high school, but turns out they know what they're doing, and it's. I didn't like the idea it doesn't have a warranty and so on and so forth. But I had, and plus I had to give her cash to buy the computer and so on and so forth. But in the end, they actually know what they're doing. It works out great. The computers are fine. They fix it themselves when something goes wrong. They don't need the repair people from Dell to show up or anything like that. So anyway, but Dell, as a company, that's kind of what they do. They put together computers from best available parts. Therefore, though, they are not as affected by supply chain shortages as other people because they say, oh, we can't get those cards. What can we get? What's available? Let's grab that. Let's get those memory chips. Let's get those video cards. So they're getting what's available on the market now. And inflation, again, what's available now? What fits our price profile? What can we put together? The other thing is that computers are such incredible, the performance of computers is way more than almost anybody needs right now. When you buy a computer, it's got way more capability than you need. You're not stressing your computer out running most applications, even the stuff that we do, even trading applications, you're not stressing your computer out. And memory, there's no disk requirements that are, we don't need X amount of disk space. We don't need X amount of this. I mean, it's insane how much storage, memory, and so on and so forth. Computers have become incredibly powerful and not much more expensive than they ever were. So again, many things in Dell's favor. Therefore, I have faith in Dell. When Dell got to $40, I was like, this is just too stupid not to buy. If it kept going lower, I would have bought more, but it's still, kind of seems to have kind of stopped here and popped right back to 50. Because as soon as they talked about what they're really making and how things are going, everybody's like, holy shit, boy, did we have that wrong. But we don't wait for that. We understand the value. And that's another thing, by the way, Buffett always stresses that do not trade things you don't understand. You can't have things in your portfolio that are a mystery to you, that you don't understand how they make money or why they're being sold. Dell was being sold for as I said, it's algo selling. It's like, how can you possibly, they're going down because other computer manufacturers were going down, the sector was going down, and analysts are idiots, and all they know is that there's a supply chain shortage. So they'll write about Dell supply chain issues. They write about Dell inflation, chip shortages, blah, 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 because they don't understand the difference between Dell and Hewlett-Packard. Which, by the way, Hewlett-Packard was extremely undervalued too. Another one we picked, but they don't understand the difference between Dell and Hewlett-Packard or anybody else on the market. They think everything's the same. Why? Because these analysts they don't really know what they're doing. You don't know who these people are. You have to look them up. There's a thing called tip ranks, which I look at sometimes. So when I read some stupid person talking about, when I read somebody telling me about Dell, and they start writing on this crap, I go and look up the analysts and say, well, what does this guy really know about Dell? What are these people? These are, by the way, they're top analysts, unknown analysts. That's great. There's a guy you want to listen to. Oh, they're saying upgrade to premium. I think I am premium. I think I'm not signed in here. No, they know who I am. I guess I'm not premium. What do you know? Go away. Wow. It's a new thing now. Is if you're not premium, they get to annoy you. Apparently, it's like now it's like even if you're subscribed at some level, they now get to just keep hammering at you until they wear you down to like try to subscribe to something. So stock analysis. Here we go. Stock analysis. But anyway, so when you're in tip ranks, you can see what the analysts say, analyst forecasts. I do have a better subscription than this. Welcome, Phil, my portfolio, go premium, my account. I don't get it. All right, whatever. I know on my other computer I can see more stuff. I'm not sure what the difference is. Maybe I signed up under my other email address. But anyway, so when you have an analyst, you can look up the analyst and find out more about them and see what their performance is. So when somebody says, when we're reading the news here and we see that some analyst is downgraded, let's see who's downgraded. Downgraded from sell to outperform. Oh, here you go, Julia Cheng. Here you go. So what does Julia Cheng know about fintech? All right, so let's go back to here. And then we put her in. Nope, she's not ranked. Oh, well. Anyway, so if somebody's ranked, you can find out here what they're like, what their scores are, whether, and then you can also see what companies they analyze to figure out if they know what they're talking about. Well, what does Bullard say? Rate hikes of 50 per meeting is good path for the Fed for Bullard. Oh, yeah, we're supposed to look at the beige book. I forgot about that. All right, anyway, all right, we'll get to that then. So you get the idea on the long-term portfolio, okay? I mean, this is from the 20th, so you can just go back to that article on the 20th and look. And what do we do though? Look at the stocks that we're doing: Disney, eBay, Facebook, Hanes brand. I mean, freaking underwear. Come on, so it's not going away. Intel's got no respect right now. Leibu's the riskiest thing I think we added to. Logitech makes peripherals for PCs. And not much after that. I don't think we had too many changes after that group. Yeah, and then all right. So Stanley, SWK, TD Bank. Come on, Tupperware again. Tupperware, and I said, is the world ending of people not buying Tupperware? What the frick? Seriously, can you possibly be this down on Tupperware? Look at them. Here's Tupperware. And keep in mind this is now $300 million to buy Tupperware. Okay, I'm sorry, but to me, when you say a brand and everybody knows what it is, that right there is a good $500 million worth of work. In the world today, there are not that many things that every single person knows, especially consumer brands. Like Harley Davidson, Mattel, Barbie, Burger King, McDonald's. There's a certain value to the actual name of something when it's something that everyone knows what it is and everyone knows what it does. That alone is something you could build a company around. Even if you change what they do, you could build a company around the fact that they actually have a brand that everybody says, "Oh yeah, I know those guys." That's years to make a reputation like that and work on it. Anyway, so $300 million. Okay. In a good year, they've made 200 million, 150, 112. So they're capable of making a good 150. That puts them at about 20 times earnings. Okay, so it's a good price. It's not a great price, but it's a good price now. And we just bet on the long-term longevity of this company. The thing that I liked about them also is that, whoops, where are we? Their debt's 560 million, so they're going to take a $10 million hit to their earnings going forward, but they'll still be over 100 million. And if they can get back to 150, if they get back to 200, it's a home run. It's 15 times earnings, but at 100 million, it's down to 30 times earnings. And I'm just betting on the long-term survival of the brand. I think it's worth playing at this kind of price because it's so low. Okay, if it was billions, I wouldn't be interested, but because it's 300 million, I think the brand of Tupperware is worth that alone. It's being undervalued as an asset. Okay, yes, they make money, but you're giving absolutely no value at all to the asset itself. And you know, as you know, I'm an old M&A guy, so I do consider these things when I'm investing. And they withdrew and see they made 28 million in Q1, so they were on the path to make well over 100 million this year. So in other words, they don't know how they're passing through their cost increases. And I said, you know, I don't care what they really do in the next year or two. I'm happy to own these guys for multiple years. It's such a cheap little stock that we're not worried about it. We're going to just keep playing it until it bounces back. Now, Yeti also really oversold, and they're on the other end because they're not as well known of a brand yet. But holy crap, I mean, getting no respect at all for what they're doing and the growth of the company. So that's crazy. Where are we? Beige book. BEIG book. Beige book. Federal Reserve. Beige book. La la la. June 1st. Oh, God, I can't believe it's June 1st. That's crazy. All right. What's up in the beige book? All 12 districts have reported economic growth since the prior beige book. That's what I was talking about this morning. That was my main takeaway this morning, which I didn't have much to say. But this is key. Barry Ritholtz brought this up. The state coincident index, a number of states showing increasing activity. Okay. A U.S. recession has needed 5 states to see declining activity for at least 7 months. Well, whether or not that's the correct number, it doesn't matter. How many states are showing increasing activity? 50. We only have 50 states. That's all of them. Every single state is showing increasing activity. How are you going to be down on the market if every single state is showing increasing activity? Something in your premise is wrong if you think this is a bad thing. And here it is again in the beige book, right? All 12 reserve districts have reported continued economic growth since the prior beige book. A majority indicating slight or modest, so it's not strong growth. A majority, you always have to be very careful about how you read these. A majority indicates slight or modest growth. 4 districts indicate Can you guys hear me okay? I got a message saying something's wrong with the audio. Not from you guys, from the computer. So Rain asked, is there a way to trade a range-bound or choppy market? Yeah, well, look, we're not day traders, so but yeah, you trade that 5% rule, and that's something we should definitely discuss in chat. So if you want to work on it, ask me in the chat room. And you want to learn what your trading range is and trade within the range. It's the best way to go. Your sound went 4 minutes back now. Thanks, Neil. Appreciate it. And Rain also said some people are afraid of microplastics with Tupperware. That's a good point. I had not really thought about that because, it's not an issue for them. It's not disposable, and it's not, I mean, eventually it gets recycled, but so that's a possible thing about Tupperware that people are concerned about because it's made out of plastic, and that's an interesting concept. I hadn't really considered that was a big negative on them. All right, back to the beige book then, since people can hear me. Retail contacts noticed some softening as consumer face higher prices. We know this. Residential real estates observe weakness. We know this as buyer face higher prices and rising rates. And we talked about that last week, how the real estate market is completely screwed. I mean, again, not to get into it every time, because I gotta assume people have heard this before from me. How do you buy a house? You buy a house because you go and get a mortgage, and the mortgage is a certain price. Mortgages were 3% last year. Now they're 5%. Soon they'll be 6%. Okay. The mortgage at 6% is considerably 50% probably more monthly payments than the 3% mortgage was. Not only that though, but you're in a house with a 3% mortgage now, and your mortgage payment and your monthly bill is X, right? That's what you can afford. If you go to look at a new house, you can't afford, even though you may have a nice gain on the house you have, when you go to get a new house, it's at a 6% mortgage. It's got a much, much higher monthly mortgage payment. People don't know this until they start looking into it. And that's what's turning all the buyers off. They're getting killed because when they run the numbers, they realize they can't actually afford to move. Not only can't you afford to move, but the refinancing activity is dying out because people can't afford to refinance their mortgage, because even if you have built up equity in your home, okay, if you've got if you have a $200,000 mortgage at 3%, you're paying $1,200, $1,300 a month for your mortgage, right? Now, if you've got 200,000 equity in a $200,000 mortgage in your house because your home value went up, right? So you want to unlock that 200,000. The problem is though, if you go to borrow $50,000 on your home, what's going to happen is that $50,000 is going to come in at 6%. So people don't want to do that because that 6%, now 6% of 50 is another $600 a month instead of it's not another $300 a month like you would think it is because it's a quarter of your mortgage. It's another $600 a month. It's a big, big difference for people, and it throws off the math. And of course, you don't want to refinance your whole home because that then takes you from 3% to 6%, and your payments go up dramatically. So people are being frozen out of the real estate market. Housing prices are very high. The home you want to move to has gained a lot of price too. So you may have gained equity in your home, but the home you want to move to has gotten very expensive, and you're sacrificing your nice low mortgage for a much higher mortgage. That's a complete no-no. So what happens is people start getting very clingy to their old homes and their old mortgages because they just can't refinance at a better level. Also, the refinance market itself dies. When rates were dropping, everybody was trading in their 5 and 6% mortgages for 3% mortgages, right? And now everybody who qualified has a 3% mortgage at this point. There's very few people, I mean, as I'm sure you know, if you're a homeowner, your phone rings off the hook by people offering you lower rates on your mortgage all the time. So as rates got down and people were getting 3% mortgages, some even less, everybody refinanced their homes at the lowest possible rates. But now you've got a country with 100 million homes that are at 3%, and where are these people going to go? in a 5 and 6% rate world, what are these people going to do? They're going to sit on their 3% mortgages. It's going to be a long time, a long time before this unwinds. So the housing market's going to be very low for a very long time. And by the way, very low though is normal. We talked about that a couple of weeks ago too. This is when everybody's bitching about how the housing market's slowing down, but it's slowing down from like a record pace. It's going back to a normal pace where 500,000 or 600,000 homes turn over a year. So out of 100 million homes, 500, 600,000 a year. I'm sorry, not 500. Sorry, month. It's about 5 or 6 million homes a year will turn over. That's still a pretty good pace. That means once every 20 years, homes turn over. That's pretty normal. We were at a once every 10-year pace. We were turning over 10 million homes a year. That's crazy. That means the average person lives in their house 10 years or less. And that's historically not normal. That's on the low side. So we're a bit on the getting on the high side now. When you talk about 20 years, we went to it and we moved to it very quickly. It wasn't a social change, it was an economic change that caused it. So that's where we are now. So labor market difficulties are great. Okay, so contacts, when they say contacts, they mean the people in business, not the actual laborers. Followed by supply chain disruptions. So labor market is the biggest problem that people have, that businesses have, not supply chain. They're more worried about the supply of labor than the supply of stuff. Rising rates, inflation overall, Russia invading Ukraine, disruptions from COVID is still on the list. Round out key concerns. See, we don't even think about disruptions from COVID. We act like that's not a thing anymore. But as I said this morning to the people in the chat room, I was listening to a statistic on TV earlier, and they're talking about in New York City, only 8% of the workers in New York City actually go to the office 5 days a week. 8%. 40% of the people in New York still do not go to the office. 40% of all workers do not go to the office at all. That means 40% of the office space in New York is not being used at all. And obviously, since most people are somewhere between with the 8% crowd, that means that probably less than half utilization of office space. That means as leases come up, companies are going to start cutting back, and that's going to really destroy the commercial real estate market. There's no way they are going to be able to ride out a contraction without some extreme pain. And we're talking about like a real shift in the concept of labor. I don't see that we're going to go back to 100% of the people showing up 5 days a week for work. We have just proven over a 2-year experiment that remote labor is almost as effective as, look, look at all these businesses that made money. Look at all the numbers that you're seeing, and everybody, look how great these businesses done in the pandemic, blah, blah, blah. Yes, there was stimulus and so on and so forth. But the reality is they were able to function. With remote work, most businesses are able to function just fine. Therefore, it is not necessary, and therefore economically, okay, because when you're paying $1,000 a foot for real estate in New York, how big is your cubicle? Your cubicle is 30 feet, right? Your cubicle's got to be 5 feet by 6 feet. Got to be, right? I can't imagine much less. You got to count your desk and everything else. So even if you're a cubicle person, your company's paying $30,000 a year for the space that you're in, plus common space, bathroom, kitchen space, hallway space. It's probably $50,000, $60,000, whatever it works out to a year. That's what it costs on top of your salary for you to sit at a desk over there. So if they believe they can get 90% of your work done or 85% of your work done if you sit at home and do the same job, You're not the only one that wants you working at home in that case. Your company would love to see you working at home because they're effectively going to save about a third of your total compensation. They can make you happy, pay you more, keep you at home, don't have to worry about you chatting with your coworkers. Now, they're going to have to get better at monitoring people at home. They're going to have to learn who should work at home and who shouldn't work at home. But all that gets worked out. You know, you deal, when you're a company, you deal with that kind of thing. I had a company in the 90s, and we were a data company, and we had a lot of data gathering people. And I decided back then that it was stupid for them to come to the office every day. I'm like, why are these guys coming to gathering data in the field all over, you know, in New York and New Jersey, I had people gathering data in the field for real estate. And they would come back to the office at the end of the day because that was how it was done. And I started going like, wouldn't it be better for them to just stay out in the field and go home and transmit the data back to the company and do their reports at home? I said, why are we making them come to the office and drive back? It's like 2 hours of their day at the end of the day for no reason. And we stopped doing it. It just turned out to be stupid. Now, did it work for every single person? No. Some people took advantage of it and would quit after lunch and wouldn't come back and blah, blah, blah. If you couldn't make your numbers, if you couldn't produce, we got rid of people. But it turned out we were able to hire a lot of really good people, especially got a lot of moms, a lot of people with kids who came back from school. They were thrilled. Got really good quality people because they were thrilled with the flexibility that we offered. You know, I don't care if you stop by and pick up your kids on your way home. That doesn't hurt me. As long as you get your data in, it's fine. What am I worried about? So, you know, these things work out over time, but the net effect in the end, though, is that these employers are going to start saying, we do not need this much office space. Therefore, we can save money. Now, at this moment, you mostly sign like 5-year leases and things like that for your buildings. It doesn't save them any money for you not to come in. So they're all screaming at people to come in. But as leases come up and people rethink their spaces, more and more people are going to start saying, we don't need this much space. Then what happens is now you're competing against people who have less space and have less cost. And then it becomes a thing where everybody's going to start trying to drive down their space on purpose. So a lot of the blowback you have when you see Elon Musk bitching and complaining about people not coming into his office and whatever, it's because he's already got the offices. It doesn't save him any money for you not to come in. He's got an empty desk sitting there with your job on it. So he's pissed off that the space that he paid for is going to waste. And many employers are like that. They don't want to walk around a room full of empty desks that's costing them $1,000 a foot. That's really annoying. And they don't have the workers to fill them at the moment either, right? There's not enough workers to fill those spaces if there's empty people. So they want to encourage you to come back to your office and sit at your desk because they already paid for it. It's a waste. But the trend, that's not where the trend is. The trend is going to be less. If you don't need this many people physically there to do the job and it saves the company money, that's where it goes. And we have just proven to corporate America that it is not necessary for all these people to actually physically be in an office. So that's going to be a big trend of change, and that's going to really hurt a lot of these commercial real estate people. Labor market, blah, 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 blah. 8 districts reported expectations of future growth among their contacts have diminished. Okay, so things are getting tougher, and they are. Okay, this doesn't say there's never going to be a recession. This says not yet. That's all this says, not yet. We're good. We're certainly more than 3 months away, probably 6 months away from an actual recession. And I'm not saying, and Barry's not saying that it's not happening. It's just not yet. Contacts in 3 districts. So 3 districts are concerned about a recession. The rest are saying we're slowing a bit. 8 others are saying, and that's 11 out of 13, right? or 12. I'm sorry. Why is it 12 districts? Did they kill a district? It used to be 13. I don't know. All right. Most districts reported that employment rose modestly or moderately. Tight labor market. One district explicitly reported pace of job growth had slowed. Hiring freezes. Other signs of market tightness have begun to ease. Okay. Oh, so the market tightness has begun to ease. However, worker shortages continue to force many firms to operate below capacity. That was interesting. I was in Miami, and a lot of restaurants in Miami, apparently this is a solution Miami restaurants have come up with. And it's funny how little regional things, people, again, experiments. People see businesses experimenting. So in Miami, a lot of restaurants have picked a day that they're closed. And they have a sign on the door saying, due to labor shortage, we are closed on Wednesday. Sorry, but whatever. So, and people are just like, okay, can't go there Wednesday, can't go there Tuesday, whatever. It's the way, if you worked in restaurants, you understand that, because you've got X amount of people, and then you allocate shifts to each person. So the people fill a certain amount of shifts. So the solution, if you're short on staff, could be obviously to spread your staff thin across all the different shifts that you need to fill, or eliminate 15% of your shifts. Therefore, you don't need the staff, and everybody just works different days. Everybody, so you say everybody's off this day. That's not how restaurants work. In restaurants, everybody's off random days. People tend to pick the days they like to be off or whatever, but of course, they need you on weekends or this and that. But people tend to pick the days off in a restaurant because you just work your shifts out the way you want to. But in this case, the restaurants are so understaffed that they're basically saying, no, everybody has to be off on Wednesday. You pick one other day, but Wednesday we're all off. It's closed. Don't have enough people to run this place every single day. And that's smart. Rather than running short-staffed every day and pissing off all your customers, you close one day. But what's the problem? Well, you're not making any money that day, are you? Now, if you can get the clients used to it, and it's a weekday, and obviously people are probably picking their weaker days, like Monday, Tuesday, Wednesday. Nobody's probably picking Thursday, Friday, Saturday, Sunday. But if you pick Monday, Tuesday, Wednesday that you're closed, and that's usually your weakest day of the week, and you find through the experiment that your customers tend to just sort of shift their habits and don't come to your place Wednesday, but that means Thursday, you don't go to most restaurants that you like every day. You go to your restaurants you like on certain days, or once a week, or once a month. You just learn not to go there that day. So a lot of restaurants can successfully shift the foot traffic to a different day. And although they're paying the rent, if they shift the foot traffic and they end up with about the same receipts over the course of the month, it doesn't really hurt them. All right, so again, experiments. You're forcing people to experiment in ways they had not experimented before. And as I'm sure you know, a lot of restaurants close Mondays and things like that. It's just some people are willing to do that. And honestly, there's not a lot of restaurants that say we're closed Mondays that change their mind about it. It turns out to be actually not a bad system. Most restaurants are scared. They're scared to give up revenue. They're scared to turn away a customer. But some of them are confident enough where they'll say, I don't know, we're just not open Monday. It's tough. Come back a different day. I frankly get really annoyed because I always forget that, and then go to restaurants that are supposed to be, I go to restaurants that are not open the day I want them to be open. Where are we? Labor markets. In a majority of districts, firms reported strong wage growth, moderate growth. Okay, majority, strong wage growth. Others have moderate growth. Everybody's got decent growth. A few districts that wage rate increases leveling off or edging down. Oh, that's interesting. So how many is a few? Moreover, while firms throughout the country generally anticipate wages to rise over the next year, one district said they expect their wage growth has fallen in 2 consecutive quarters. Holy crap. Those are cracks. There are cracks appearing in the wages and so on and so forth. Most districts noted that their contacts had reported strong or robust price increases. Input prices have gone up a lot. 2 districts know now input prices going up means that we're still behind the ball on inflation. 2 districts noted this rapid inflation was a continuation trend. However, observed the price increases for their own goods had moderated somewhat across the board. or for some segments. Half the districts observe many contacts maintain pricing power, passing costs on to clients and consumers, often with fuel surcharges. However, more than half the districts had some customer pushback. So in other words, we're still pushing inflation forward. The customers are starting to buckle under the inflation pressure, and that's where it starts. That's where the wheels come off the bus. Because we're getting to the point where the consumers can't afford anymore. Now, they're also at the same time telling you we're not giving them any more raises. We can't, we're cutting back on the raises, aren't getting automatic. We're not going to keep raising these wages. So you're not raising wages. The customers are running out of money. They're pushing back on prices. The increases are still coming through from the back to the manufacturers. That's a problem. That's where you can start seeing margin compression. And that's how you end up with a recession. But it's a very slow moving game. Smaller volume purchases, substitution of less expensive brands. Surveys in 2 districts pegged year ahead prices as ranging from 4 to 5% more. One noticed firms' price expectations have edged down, blah, blah, blah. Okay. Oh, and then the district thing sucks, so we might even worry about that. All right, good. Don't forget, though, that again this morning, as I've had time to contemplate the situation, it's good when I go away. I only went to Miami, but it's good when I just go away and talk to different people for a while sometimes, because get a glimpse of what's going on. So I talked to a lot of hotel people and talked to some restaurant people this weekend, and so on and so forth. So gas is key, but to me, if you have really high fuel prices, it's driving inflation. It is so much of what's driving inflation is this incredible price of fuel right now. That's being caused by the war. Will the war end is question number one, but eventually it'll end. One day it will end, and things can go back to normal pretty quickly because gasoline is driving so much of the increases in inflation. It's not a multi-pronged thing. I mean, yeah, we had supply chain issues and so on and so forth, but again, a lot of the stuff it was driven by COVID, which is winding down for sure, and it's being driven now by the war, which is driving gas prices through the roof. Either the war winds down or the production of gasoline and oil picks up, and there will be more available from non-Russian sources. And even OPEC is saying, yes, OPEC sees a surplus of oil. They're like, demand is not catching up with our production. We have a surplus of oil right now. It's really the refined product. It's really gasoline. We don't have the production capacity for gasoline right now. And of course, natural gas is a whole different ball game because it's not as easy to move it from one place to another. Yes, we have LNG, but not enough. We don't have enough containers and enough ships and enough production facilities to really have natural gas be very fluid. So you can get bottleneck shortages all over the place. Interestingly enough, though, we're the ones exporting all the natural gas, and we're paying through the nose for natural gas, even though we have so much of it that we're supplying half the world with natural gas. But we're paying the global price for natural gas because they'd rather ship it out of this country and make the consumers in the US pay than let us have the cheap natural gas to ourselves. So, what are you going to do? It's capitalism, right? So that's where we are. See if there's any big questions here. Mark says, hey, Phil, long-time on and off user, homesick with COVID. Oh, man, sorry about that. From SpaceX, what? Did you go to space and get COVID? Wait, what does that mean? I lost money, $10,000 on Frontier years back. I'm getting a class action settlement mail. Wow, you got a lot of stuff going on. So wait, you went to space and got COVID. You lost money on Frontier, but you're suing them with a class action thingy. You're getting class action settlement mail. I see. From Frontier, well, okay, let me tell you something. That was a massive misrepresentation by management. That's how we got locked into it. They kept saying how things were fine. They were refinancing their debt, blah, blah, blah. It was all bullshit. But then when they did the bankruptcy, they screwed all the shareholders. sign on, you may as well sign on. You got nothing, right? So if you have shares and you get a thing in the mail, sign up. You know, it doesn't require much effort on your part. The lawyers might say you were formed, but it's, you know, they either win and you get a cut, which is probably going to be nothing, or they don't win and they never hear from them again. So I wouldn't worry too much about it. But yeah, those are kind of fun to get involved in. But really don't put a lot of faith into what's going to happen. I'm much more interested in details about how you got COVID from SpaceX. That's very interesting. So there's a lawsuit, right? If you go up in a capsule and get COVID, I think you can sue over that. Please go over the new hedging trade right now and what % of the portfolio should be spent on hedging, says SK. Well, that would be the short-term portfolio. So we go from the long-term portfolio to the short-term portfolio. Now, notice, all right, we started the long-term portfolio with $500,000. We started the short-term portfolio with $200,000. We really started with $100,000 and put another $100,000 into it when the long-term portfolio was doing super good and the short-term portfolio was doing super bad. But now the short-term portfolio is 1.2 million. The long-term portfolio is only 2 million, or not even 2 million. So the short-term portfolio is catching up to the long-term portfolio. But as a rule of thumb, I would start off with about 20% in the short-term portfolio of your 20% hedging in the short-term portfolio. And the key is, though, that whenever you make unrealized gains in the long-term portfolio, then you want to add those. You want to add about 1/3 of the unrealized gains to the short-term portfolio. Now, if you have cash in the short-term portfolio that you can use that cash. I'm not saying constantly transfer money, but when you have a lot of cash in the long-term portfolio, when you have a lot of gains, you do have to take some of the money if you run out in the short-term portfolio and transfer it to your short-term portfolio and utilize it, okay? Because you're locking in those gains. So in other words, what you're going to do is you're going to sacrifice 1/3 of your gains and put it into hedges that should pay at least 2 to 1 on the way down. And I mean a profit of 2 to 1. So pay 3 to 1 back. So you want to get into hedges that pay you will pay you 200% profit back, which means that obviously your long-term portfolio gains are locked in. As you know, as you make $100,000 long-term portfolio, you take $30,000, put it in the short-term portfolio, and if the market drops, then the short-term portfolio goes from 30 to 90, the position, while the long-term portfolio gives back the 90 it gained. So now you've got 90 cash in the short-term portfolio instead of 90 in positions in the long-term portfolio. But the most important thing, you kept your gains. That's the magic of this thing. That's how we end up with so much cash in the short-term portfolio, because then eventually we get to a bottom where we start cashing out some of these unrealized gains in the short-term portfolio. Then we have a ton of cash. We just sent $100,000. This would actually be a bigger number, but we just sent $100,000 of cash to the Futures Now portfolio, I think, because that took a big hit. We put more money in that portfolio from the short-term portfolio, and now we have money to buy more longs or to increase our long positions in that portfolio. That's what it's all about. You just want to keep your buckets organized and make sure you know what you're doing as far as that goes. But as a rule of thumb, you start out with maybe 20% of your money in hedges. And as you grow your long-term positions and as you grow your unrealized gains, you want to add to your hedges. Just make sure you just keep putting money in. And every time your long-term portfolio goes up, how much money should you be putting in? I'm talking about, like we do a monthly review. And on a monthly basis, we'll add to our short-term portfolio or the long-term. We start out with very, very modest positions. Now we have massive, massive positions. We've got 400 long SQQQs, $1 million worth of SQQQs. So let's take a look at what this is. All right, so we've got 1024123 minus 203,123 minus 152,250 minus 843,750. So we have negative. The net value of this hedge is, whoops, there you go, is negative $174,000. The hedge itself is 400 30s and 70s are our shorts, right? So they're 400 times a $30 times a $40 spread is $1.6 million. So at 70, this spread would go from negative 174 to positive 1.6. So there's basically $1.8 million of hedging in this position. All right. Now, this is based on the math I did before, which we talked about when we were in the midst of it. I don't believe that 70 is sustainable on SQQQ. So we're taking a chance because we're heavily negative here as far as our short calls, but we're taking a chance that these will burn off worthless, especially these guys, this negative 300,000, that burns off in 6 months. So we're taking a chance that we don't hit 70 this year. If we don't hit 70 this year, we're in great shape. We've got we still into next year have $1.6 million worth of hedges before we owe any money back on the short 70 calls. And again, based on our valuation model for the NASDAQ, we do not believe 70 is going to be a sustainable number on SQQQ. Not to mention it deteriorates naturally over time anyway. And especially now that we're at 47, 70 is getting to be pretty far away, 50% away right now. So 50% would take a 17% drop on the NASDAQ from where it is right now to hit 70. So this one is a $1.6 million hedge. Then TZA, which is properly covered. We're not taking a chance on TZA. We've only got a little tiny bit, 50 and 25 short extra calls. No, I'm sorry, 150. I'm sorry, it's 175. We have those short calls too. But those are, again, those are pretty far out of the money. We don't think it's likely they get hit. So the crux of it is a $20 spread, 600 of those, so that's $1.2 million. So that means we have $3 million worth of total hedges. And yes, if we go over 45, we have to start paying back, but we're not really paying back TZA because those are covered. But if we go over 45, those get hit. If we go over 70, these get hit, and that would diminish our $3 million hedge. But $3 million is more than the STP and the LTP are worth combined. And that's our hedge. And we already have $1 million, so we'd be looking at like $4 million of value in this portfolio. Plus, we would obviously adjust it along the way. We wouldn't allow ourselves to get so killed. But as it stands right now, that's where we are. So we have 600 of these, so like I said, 1.2 million. How much is the net of the TZAs? Well, the net of the TZAs is 582,123 plus 582, whoops. Oh man, screw that up. 582,123 plus 582,123 plus, well, actually minus 865,500 minus 38,688 minus 2,750. So it's 239, but then minus this other 100 up here. But if you just did this one, which is very conservative, it's 239 for the $1.2 million spread. And that $2 million spread is 12 in the money. So what's 12 times 6 is $720,000 in the money. It's crazy. So for 239, you can buy this spread that's 700 and something thousand in the money. And we also sold these short calls, which knocks it down from 239 to minus 119,750, 119. So we're only spending 119 for 1.2 million in hedging here. All right, so remember we said we can gain 1.8 million here and 1.1 million here. So that is plus 3 million. That's 3 million more than our current total of 1.2. So well over 4 million bucks if the market crashes. We'll have in this portfolio alone. So if we don't kill the entire long-term portfolio and salvage 50% of its value, which would be about $1 million bucks, and this thing hits 4 million, we would then have $5 million in the portfolios. Now, we would then have to deal with the damages from the short 70s and the short 60s and so on and so forth. That would knock off some money, but it ain't going to knock off more than $1 million bucks. So at the moment, we would actually do better if the market collapsed than if it goes up. If it goes up, we don't probably think I don't think the long-term portfolio is going to go up past $4 million. So yeah, we would certainly, right now, we would certainly make a lot more money in a crash than we would if the market goes up. I mean, assuming, the market doesn't double over the course of a year or something like that. But in a normal market, if it goes up 20%, that's not going to be anywhere near as good for us as if the market goes down 20%. So therefore, we are still pretty bearish. Okay, our overall position is pretty bearish, but also because of the heavy amount, and that's why we have this, because of this heavy amount of short 70 calls that expire this year, which is 203, $350,000 worth of those, we feel pretty confident that our hedges aren't going to kill us in an up market. So it's all about balance. That's really what it's about. And it's a lot of work. It's not like there's not like a two-step process to it. It's a lot of work to make it work this way. And SK is saying, does it make, oh, I'm sorry, wait a second, hang on a second. There's several back and forth here. All right, so SK says, okay, we talked about the hedging, and absolutely feel free to follow up in the chat room because this is a big topic that's very important to everybody. Mark says he's an engineer at SpaceX, not an astronaut. He wants to say SpaceX is a remarkable company, faster and harder working than I've ever known. Just got to keep Elon off Twitter. He's brilliant and very involved. Well, that's cool. I envy you, Mark. I mean, I mean, how freaking amazing is that to actually work on rockets and exploring space at the dawn of space exploration? I mean, you're the man. I think that's fantastic. So cool. Good on you. Elon, I got a lot of issues with. He's a little bit of a huckster, but I mean, there's some real work getting done there. Brilliant but flaky. I'm very upset about the way it's the Tesla thing that pisses me off. It's the auto drive and how he doesn't seem to be as concerned about the safety of the people as I'd like him to be. And again, it's because you're kind of cutting corners or cutting corners as far as saying something's not ready, it's not ready. Don't pretend it's ready when it's not. And I hope for space that's not an issue, but for cars it's been an issue. But holy crap, you got the dream job, man. I mean, my whole life. I guess I should have probably studied more engineering, but my whole life I've always thought that was like the coolest thing. I've always been a science fiction fan. SK says, does it make sense to have two different accounts, one for the LTP and the STP? How does it affect portfolio margin? Well, it depends on who your broker is. Like Thinkorswim easily lets you have two accounts and takes it all into account with the portfolio margin. You can flip from one account to another account in Thinkorswim. Otherwise, you just have to do it yourself. You have to keep track. But most brokers, I imagine, will allow you to combine multiple accounts and spread your portfolio risk across it. However, having a NASDAQ hedge doesn't necessarily mean they're going to count that as a positive against your short Google puts or something like that. That's not generally the way they'll do their calculations. They should, but they don't. Even Apple, which obviously has a huge effect on each index. But you have to talk to your broker about it. Just have an honest conversation with your broker and say, here's what I'm trying to accomplish. Otherwise, section it off in your portfolio. Keep it all in one portfolio and just keep your own track. That's in fact one of the reasons I found Power Options is because I wanted to do that. I wanted to have a clearly separate account, and I found that this was super helpful, just putting things into these different portfolio buckets because they let you set up as many portfolios as you want. So I like that about this. It's a good little service. It's a nice thing. You gotta manually put it all in. There's no easy way to do it, but unfortunately, but as far as organizing your trades, I don't know. I don't know of anything better. It's just wonderful to be able to look at my TZAs like this and see exactly what's going on. That's huge. Because it's a nightmare for me to look at these on the trading platforms. I'm never happy with the way they set it up. All right, guys. So, 2:55 already, man. All right. Well, thanks everybody for coming. I appreciate it. And we will. Oh no, we won't do it again next week. I apologize. I am in Orlando next week, so I cannot. I can almost guarantee there's not going to be a webinar. In fact, there won't be a webinar. Let's not even pretend. There will not be a webinar next week. I'm going to be in Orlando. I don't know what I'm doing. I don't know what my schedule is. So no webinar next week. Week after that, everything back to normal after that, though. All right. So have a good week, everybody, and I'll see you in a couple. All right, take care. Oh, Dave says TOS Thinkorswim allows you to put trades into groups. All right, so check out that function also. The Thinkorswim guys are generally very helpful. I mean, just call them up on the phone and ask them stuff. All right, take care, folks.